What valuation assumptions impact a family business's worth? Imagine trying to value a family business without knowing what assumptions are behind the numbers. It's like trying to hit a target in the dark. Understanding what influences the worth of a family business is key to building lasting wealth and planning for future generations. When it comes to business valuation methods, the assumptions you make about future earnings, assets, and market conditions can change the entire picture. First, the choice of valuation method plays a big role. If you use an income-based approach, you're estimating future profits and discounting them to today's value. This depends on assumptions about growth rates, profit margins, and risk levels. For asset-based methods, the focus is on the value of tangible and intangible assets minus liabilities. Here, assumptions about asset worth and depreciation are critical. Market-based methods compare your business to similar companies, so assumptions about how comparable businesses are valued and market stability matter a lot. Next, the discount rate or capitalization rate is a major factor. A higher discount rate suggests more risk and lowers the business's value. If you assume the industry is unstable or economic conditions are uncertain, you might choose a higher rate. Conversely, a stable industry with predictable cash flows might justify a lower rate, boosting the valuation. Projected future earnings or cash flows are also vital. If you assume the business will grow rapidly, the valuation increases. But overly optimistic projections can lead to overvaluation, which might cause problems later. On the other hand, conservative estimates might undervalue the business but provide a safer picture for planning. Control premiums or discounts are another consideration. If the valuation includes the value of owning a controlling interest, it's higher. If it's for a minority stake, it's usually discounted. These assumptions impact how much the family can expect to receive when passing on ownership. Market comparables relying on assumptions about how similar companies are valued. Differences in size, location, or growth prospects can make applying multiples tricky. If you assume the market is highly competitive or that comparable companies are undervalued, your estimate will change accordingly. Family dynamics and succession plans also influence valuation assumptions. If you believe leadership will stay stable and management will continue to perform well, the business appears more valuable. If there's uncertainty about future leadership, the value might be lower. Tax and estate considerations are often overlooked but are essential. Assumptions about tax rates, estate taxes, and planning strategies can significantly affect the net value passed to heirs. For asset-heavy family businesses, assumptions about asset valuation, depreciation, and liquidation value can swing the valuation one way or another. In practical terms, regularly updating valuations with realistic assumptions helps guide smooth ownership transitions. It also helps in estate planning to minimize taxes and preserve wealth over generations. Balancing optimism with caution in your assumptions ensures you don't overstate the business's worth, protecting long-term financial security. In the end, the assumptions you make about valuation methods, risk, future earnings, control, family factors, and taxes all shape the true worth of your family business. Paying close attention to these assumptions helps you make smarter decisions, ensuring your legacy remains strong and your family's wealth grows steadily over time.